Most people think taxes are simple. You earn money, the government takes a portion, end of story. But if that were true, everyone would be taxed the same way. In reality, the tax system isn't built around how much money you make. It's built around how you make it. And that single difference explains why some people feel crushed by taxes, while others legally pay very little. The 3 types of income. At its core, the tax system recognizes 3 main types of income. Earned income. This is money from jobs and salaries, wages, hourly pay, bonuses. This income is taxed the highest and the fastest. Taxes are taken before you even touch the money. That's why most employees feel tax pressure the most. Portfolio income. This includes dividends, interest, and capital gains from investments. This income is taxed differently, often at lower rates, especially if held long-term. Business income. This comes from owning businesses or self-employment. This is where the most flexibility exists, because expenses can be deducted before taxes are calculated. The tax system rewards ownership more than labor. Why salaries are taxed first. Governments prefer predictable tax collection. Employees are easy to tax because income is fixed. Payments are regular. Employers act as tax collectors. That's why payroll taxes are automatic. Business owners and investors calculate taxes after expenses, depreciation, and deductions. Same amount of money. Very different treatment. Deductions versus credits. This is where confusion begins. Deductions reduce taxable income. Credits reduce the tax bill directly. Employees usually get limited deductions. Business owners and investors get many more. Things like equipment, travel, office space, depreciation, interest payments. The system allows money spent on production to be taxed less than money spent on consumption. That's not a loophole. It's intentional. Section 4. Why the rich use assets, not paychecks. Wealthy individuals don't focus on salary growth. They focus on asset growth. Assets generate income in ways that are tax-deferred, tax-advantaged, or taxed later at lower rates. Examples include real estate, businesses, equity investments. They also borrow against assets instead of selling them, avoiding taxable events. Taxes are triggered when money moves. Assets allow money to sit and grow. The purpose of the system. The tax system isn't evil. It's functional. Governments need workers to produce, consumers to spend, owners to build businesses. The system encourages employment stability, business expansion, long-term investment. The problem is, most people are only taught how to earn, not how to structure income. Why it feels unfair. It feels unfair because workers carry the heaviest load. Owners have the most flexibility. Knowledge changes outcomes. 2 people can earn the same amount and pay wildly different taxes, legally. Not because one cheats, because one understands the rules. Taxes are not just about money. They are about behavior. The system taxes consumption and labor heavily and rewards ownership, risk, and long-term investment. If you only earn money, you'll always feel taxed. If you own systems, you learn how money flows around taxes, not through them. That's not privilege, that's literacy. If you want more clear breakdowns of how money systems actually work, subscribe to Financial Patterns.